Here are three proposals that Donald Trump has made that could be coming your way when it comes to the tax code. Number one, Donald Trump has proposed to rid away with federal income taxes and resort to a tariff-only situation. If we were to have tariffs as opposed to federal income taxes, there wouldn't be a need to file income tax returns, and most of the money that you would pay taxes on would just be on imported goods that come from other countries. This could be beneficial but also harmful to our government. Number two is reducing or eliminating taxes on tips. A lot of people that are in the restaurant industry make a majority of their income on tips. This could end up sparking a lot of people shifting jobs into the restaurant industry, reducing the amount of federal income that we collect off of tip employees. And number three, reducing corporate income tax rate from 21% down to 15%. Donald Trump, during his Tax Cuts and Jobs Act, reduced the corporate rate from 35% to 21%. He is proposing reducing that corporate rate from 21% down to 15%. Comment below if you like any of these tax proposals. I have the most tax strategy content on the internet, bar none. And the reason why is because of my mentor. He taught this to me years ago. His name's Karlton. Grant, in about 2017, introduced me to the word omnipresence. Now, before Grant, I had learned it biblically from the Bible, which God is omnipresent. He's in all places at all times. I'm a big believer in Christ. That being said, in the business sense, Grant's idea was if you can have omnipresence over your content where people are thinking about you, talking about you all times because of the amount of content you're putting out, you can create this omnipresence vibe in the space that you're in. So in the tax and accounting space, when people think of LLCs, S corporations, tax strategy, I want them to think of Karlton Dennis. So how do I solve that problem? I'm on every single platform, YouTube, Instagram, Facebook, TikTok, Rumble, you name it. I'm posting there every single day, and I do not care because I care about omnipresence. I will outdo every other tax professional on the internet because that is my intention. I can keep up with the greats in their spaces because I have practiced omnipresence in my space. All my staff own rentals. You can't come into my office as a CPA or enrolled agent and tell somebody to buy real estate to avoid taxes, and you don't even own real estate yourself. What type of tax professional would I be if I'm telling you to do the Augusta rule, to place your children on payroll, take a home office deduction, if I haven't even done any of those strategies? So yes, all of my CPAs, all of my tax professionals have to own rental real estate to work in my firm. Here are three ways I'm building wealth for my 1-week-old daughter. Number one, I've established a 529 plan for her. This will allow for me to save money for her college tuition. Anything that's not utilized for college will be able to be rolled over into a Roth IRA. That leads me to the Roth IRA. I'm putting $6,500 into a custodial Roth IRA account for my daughter. So by the time she turns 18, she's gonna have multiple six figures. By the time she's 60, it'll be over 7 figures inside of her Roth. And last but not least, I'm buying multifamily properties, and I'm setting the terms on these multifamily properties to be paid off by her 18th birthday. That way, I have a gift for her right when she turns 18. Comment below if you'll be setting up strategies for your family as you grow your wealth. When your accountant doesn't help you, you have to turn into Indiana Jones, scourging through the internet to try to find a solution. But then you get overwhelmed because you find out that the tax code is over 80,000 pages and there's differences of opinion online as it pertains to strategies. So what do? You partner with the right type of professionals that present to you all of the strategies within the code that are applicable to your type of income, and they help you make a decision based on your goals and your vision. Here's how to avoid capital gains taxes when you decide to sell your home. It's called the Section 121 exclusion. And what this tax code will allow for you to do is if you owned a primary residence that you have lived in for 2 out of 5 years of ownership over the last 5 years, you can sell the property and experience a $250,000 capital gain exclusion, which means the first $250,000 of gain from the sale of your home is excluded from taxes. If you're married, this $250,000 jumps up to $500,000. So you could walk away with $500,000 tax-free just by owning a primary residence that you lived in. Comment below if you'll be utilizing this strategy as a part of your wealth building. Depreciation recapture. Let's talk about it. It's the elephant in the room when we're talking about accelerating depreciation with cost segregation studies. My clients don't pay depreciation recapture. The reason why is because I'm very clear. Before we accelerate depreciation with a cost seg, are you a believer in real estate? Not like I'm a believer for the short term. Do you want to do real estate for the long term? Because if you do, you're going to leverage strategies like the cost segregation study to accelerate depreciation, knowing that there's depreciation recapture on the back end if you sell your properties. So a person that believes in real estate is not going to just sell the properties. They're going to 1031 exchange the properties. So that way they're not causing themselves a taxable event. A CPA who instills fear in you like they work for the IRS is not a great CPA. That's a lazy CPA. Because the reason why they don't want to help you figure out the tax code is because it's easier for them to be more conservative and tell you what you can't do, making their job easier as your accountant. You need to run away from CPAs that aren't willing to show you how to leverage the tax code.